Welcome to The Deep Dive, your shortcut to understanding the crucial insights from today's earnings calls.
Indeed, and today we're tackling Baxter International's first quarter 2025 earnings call.
Right. Our mission, as always, is to pull out what really matters for you. We'll break down their key financials, strategic updates, and what it all signals going forward.
And Baxter's Q1, well, it came in stronger than they'd guided for.
Oh, really? On both top and bottom lines?
Yeah, exactly. They beat their previous guidance for both sales and earnings per share. Sales from their continuing operations grew 5%, reported and operational.
Okay, 5% growth. What does that translate to in dollars?
That reached $2.63 billion. And adjusted earnings per share from continuing ops were 55 cents.
Solid numbers. And you said growth across the board.
Pretty much. All three of their main continuing segments, medical products and therapies, healthcare systems and technologies, and pharmaceuticals, they all reported year-over-year growth.
Okay, let's dig into those segments then. Maybe start with the biggest one, medical products and therapies, MPT.
Sure. MPT sales hit $1.3 billion, which is up 6% compared to last year.
And what was fueling that 6%?
A really significant driver was double-digit growth in their U.S. infusion systems. Seems like the continued rollout of that NOM IQ pump platform is really paying off.
Hospitals must be adopting it then. What else in MPT?
Nutrition also performed well, showing mid-single-digit growth. That was particularly strong in alternate care sites in the U.S.
Interesting. How about IV solutions? That's usually a big piece for them.
It is, but growth there was more modest. Low single digits. Production's apparently back to where it was before the hurricane, and they're rebuilding inventory.
But hospitals are still being careful with fluids.
Yeah, seems like they're still seeing some of that fluid conservation happening in hospitals. And finally, advanced surgery grew 4%.
Okay, 4%.
Yeah, strong international demand helped there, offsetting a couple things in the U.S., like fewer billing days in comparison against clearing back orders last year.
Got it. Okay, moving on. Healthcare systems and technologies, HST, smaller segment, but you said it grew too.
It did, and it actually exceeded expectations. Sales were up 6% to $74 million.
Wow, okay. What drove that?
Their Care and Connectivity Solutions division, CCS, was a real standout. It grew 7% globally, but a really strong 14% in the U.S.
14% in the U.S., that's significant.
It is, driven by patient support systems and some important competitive wins. And what's maybe even more telling is that U.S. capital orders for CCS jumped 20%.
20%? That suggests a healthy pipeline.
Exactly. A healthy backlog points towards maybe continued strength there. They're still watching the macro picture for capital spending naturally.
Well, naturally. And the other part of HST, frontline care?
That was up 5%. Benefited from an easier comparison to last year, and they're seeing some stabilization in the U.S. primary care market.
And internationally for HST?
They expect international capital orders for CCS to start contributing more to growth later in the year.
Okay, makes sense. That leaves the third segment, pharmaceuticals. How did that shape up?
Pharma sales increased 3%, reaching $581 million.
And within that?
Injectables and anesthesia grew 4% combined. Strong international growth in specialty injectables helped offset lower anesthesia sales, though they do expect anesthesia to stabilize.
Okay. And drug compounding.
That grew 2%, but it was up against a tough comparison from a strong prior year.
Right. Comps can be tricky. Was there anything else affecting the reported numbers?
Yeah, it's worth noting they had $63 million in MSA revenue from VanTeeve. That's included in the reported growth, but not the operational growth figure.
Ah, the transition service agreement revenue from the spinoff. Got it.
Exactly.
So, top line looks decent across the board. Let's pivot to profitability. Margins, expenses, how did that look?
Well, the adjusted gross margin came in at 41.8%. That's actually down a bit.
Oh, why was that?
Partly due to those VanTeeve MSA revenues we just mentioned, and also some higher costs related to planning and fulfillment.
Okay, but what about operating expenses? S-GNA.
Good news there. Adjusted S-GNA actually decreased as a percentage of sales, down to 23.2%.
How'd they manage that?
It seems to be a mix of reclassifying some functional costs and lower stock compensation expense.
And R&D, are they still investing?
Definitely. Adjusted R&D spending actually went up to 5.3% of sales, so they're clearly still focused on bringing new products through.
That's usually a good sign for the future. Anything else impacting profit?
Yeah, they had $40 million in TSA income and other reimbursements. That was higher than they expected.
More transition services income.
Seems Vantage needed a bit more support than initially planned under that agreement.
I see. So when you put all these pieces together, the gross margin pressure, lower SG&A, higher R&D, that extra TSA income, What happened to the operating margin overall?
It actually improved. Adjusted operating margin landed at 14.9%.
Oh, nice. So the operational execution and that TSA income really helped.
Exactly. And if you look by segment, MPT's margin increased to 19.3%.
Yeah.
HST also improved, up to 13.2%.
And pharma?
Pharmaceuticals saw a slight decrease, down to 10.8% adjusted operating margin.
Okay. And below the operating line, interest, tax?
Net interest expense decreased to $64 million, which is good, reflect their debt repayment efforts.
Right.
And they also had about $17 million in adjusted other non-operating income, mostly from lower foreign exchange losses than anticipated.
And the tax rate?
The adjusted tax rate was 17.4%, benefited from some strategic tax attributes they kept after selling the kidney care business.
Okay, so that wraps up Q1. A pretty solid quarter, it sounds like. What about the outlook? Did they update their guidance for the full year 2025?
They did. For the full year, they're now expecting reported sales growth of 7% to 8%.
That's an increase from before, isn't it?
It is, yeah. But it's mainly due to more favorable foreign exchange rates.
The FX tailwind on the top line.
What about operational growth, excluding FX and things like the MSA?
That guidance remains unchanged. Still expecting 4% to 5% operational growth, excluding FX, MSA, and that China Fed exit impact.
Okay, and how does that break down by segment for the year?
MPT is still expected around 5% operationally, and that's after accounting for about 100 basis point drag from exiting China Fed.
HST is projected around 3%, and pharmaceuticals looks like 5% to 6% operational growth.
Got it. Now, you mentioned headwinds earlier. Tariffs came up, right?
They did. They're estimating a net negative impact of about $60 to $70 million from tariffs this year.
Ouch. When does that hit?
Mostly in the second half.
Mm-hmm.
They said they're working hard on mitigation, talking to suppliers, looking at shipping alternatives, some targeted pricing, and advocacy efforts.
Which tariffs are the main issue?
China tariffs are nearly half the total impact, apparently. They haven't factored in any potential pharmaceutical tariffs yet, though.
Okay, something to watch. And you mentioned FX helps the top line, but what about the bottom line?
Yeah, that's the tricky part. While favorable FX boosts reported sales, it's actually expected to negatively impact their adjusted operating margins and EPS.
How come?
It's due to their current infrastructure setup and how costs and revenues are distributed globally. Hedging plays a role too, of course.
Interesting dynamic. So, given all that, what's the revised profit outlook for the full year? Operating margin.
They've updated the full-year adjusted operating margin guidance from continuing operations, now expecting between 16% and 16.5%.
Okay, a tighter range. And the TSA income.
They now expect that to be higher for the full year, between $140 and $150 million.
So putting it all together, earnings per share guidance.
They've raised it. Full-year adjusted EPS from continuing operations now anticipated in the range of $2.47 to $2.55.
Raising guidance despite tariff and FX headwinds, that seems positive.
Yeah, it reflects the Q1 beat and confidence in operational execution offsetting some of those pressures.
What about the near term? Any guidance for Q2 specifically?
Yes. For the second quarter, they're forecasting reported sales growth of 4% to 5%.
And operational?
Operational growth is expected to be slower, 1% to 2% for Q2.
Why the slowdown from Q1 operationally?
Well, FX is expected to give about a 50 basis point boost to the reported number in Q2.
Sure.
MSA revenue should be around $80 million, but that China 30 exit will hit Q2 top-line grade by about 70 basis points.
Okay, so some specific Q2 factors there. And EPS for Q2?
Expected between 59 cents and 63 cents adjusted.
Okay. Were there any other sort of key takeaways or miscellaneous points from the call that jumped out at you?
Yeah, a few things. They mentioned the search for a permanent CEO is active and going well.
Still interim leadership for now then.
Right. They also stressed their focus on strategic investments, both organic R&D and potentially some smaller bolt-on acquisitions in growth areas.
Makes sense. What about the balance sheet? Debt levels?
They're on track to hit their target of a net debt to EBITDA ratio of 3 times by the end of this year. That's a key metric for financial health.
Getting leverage down. Any talk of share buybacks?
They hinted at the possibility of reinstating a buyback program in the future, once leverage targets are met, presumably.
Okay. Anything else?
Interestingly, they noted lower oil prices won't be as big a benefit as maybe in the past.
What's that?
Mainly because they divested the kidney care business, which was more sensitive to energy costs.
Okay. And you mentioned the operational growth slowdown from Q1 into Q2.
Yeah.
Did they elaborate on why?
Yeah, they attributed it mainly to that ongoing IV fluid conservation trend we talked about, plus maybe a bit of conservatism in their near-term HST outlook. But they did say the first half overall is tracking pretty much as they expected.
So no big surprises internally, it sounds like.
Seems that way. And that lift to the bottom end of the full year EPS guidance, that was really driven by the strong operational performance, plus those favorable interest and tax rates helping to balance out the tariff and FX hits.
Got it. And the drivers for that strong HST performance, especially in the U.S.?
It really sounds like the strong backlog from those capital orders and the competitive wins are key for CCS in the U.S. Digital enhancements are helping too. They expect international CCS to pick up later, and frontline care seems to be stabilizing.
Okay. And long term, still focused on margin expansion.
Absolutely. They reiterated their commitment to that through, the usual levers,
Right.
growth, innovation, pricing, mix, cost-saving programs, and getting rid of those stranded costs from the divestiture.
And the NOM IQ pump, still gaining traction.
Yep, they mentioned it's gaining market share kind of in the low single digits, and they highlighted a strong ongoing innovation pipeline behind it.
Okay, quite a bit to digest there. Now let's shift gears slightly for our This Is Not Financial Advice segment.
The fun part.
Right. So thinking about Baxter, that really strong performance in healthcare systems and technologies, HST, stands out, especially that 20% jump in U.S. capital orders for CCS.
Yeah, that 20% figure is pretty eye-catching, especially with their confidence despite, potential macro wobbles.
Exactly. So here's an outrageous but plausible idea, purely a thought experiment for you listening.
Emphasis on thought experiment.
Absolutely. What if you considered a long position not in Baxter directly, but in companies that specialize in, say, hospital construction, renovation, or maybe even the specialist installation services needed for this kind of advanced connected care equipment?
Interesting angle. So the idea is, if Baxter is selling all this new capital equipment,
then hospitals might need to upgrade their rooms, their infrastructure, their networks to actually use it effectively. So you're playing Baxter's success, but maybe in a more leveraged, indirect way via the service providers who benefit downstream.
okay, I see the logic. It's definitely a step removed, makes it speculative. Is there a hedge?
Well, again, purely speculative, maybe a small tactical short position in a direct competitor of Baxter's in that HST space, specifically one that seems to be lagging on the digital connectivity side.
The thesis being, if Baxter's winning because of digital, the laggards might lose share. High risk, though.
Extremely high risk. Could go wrong very easily. So, to reiterate for everyone, this is absolutely just kicking ideas around, not investment advice. Please do your own detailed research before ever considering any trade.
Couldn't agree more. Deep diligence is essential.
Okay, well, that brings us to the end of this deep dive into Baxter International's first quarter 2025 earnings call.
We've covered the financials, the segment performance, the updated outlook, quite a bit.
And even a wild trade idea. Hopefully, this breakdown has given you a much clearer view of the key information and potential implications for Baxter right now.
Yeah. What stood out most to you as you were listening? Any questions still lingering?
Definitely encourage you to dig deeper if this sparked your interest.
Absolutely.
Thank you for tuning in to The Deep Dive. Join us next time as we dissect another crucial earnings call.